Living with volatility, that's a word we hear quite often these days. But risks and opportunities actually can be made in a fractured economy. So welcome from Moody's. Thank you so much, Colin Ellis and Marie Elvesol. Welcome. It's a big question. And big questions. There are opportunities, but there are also loads of risks. And just to start with a small question now, how will the economic fallout be with the ongoing in the Middle East?
I mean, the honest answer is we don't know.
No.
Because we have to wait and see how the situation unfolds. But it's obviously clear that the market reaction this time around has been much stronger than what we saw last year when the US attacked Iran. And in part, that's because we are seeing Iran active more decisively, particularly with the Straits of Hormuz. And that's obviously the narrow gap, which about 20% of the world's oil and natural gas supplies kind of flow through that corridor. So if you can't get energy out of the Gulf and to the people who want to use it around the world, which particularly Asia, but also Europe, that can have a very big impact. And in our scenarios, the work that we've done, if you saw a significant disruption where the oil price averaged $110 a barrel in Q2 and still over $100 a barrel in Q3, that could knock 1 percentage point more or less off global growth this year, and it would still have an impact in 2027 as well. So we have to see how this plays out, but we are talking about significant risks, even if those risks are not evenly distributed around the world.
Would you say, I mean, every time, especially journalists like me, we try to compare crises with other crises. 1973 or, well, as you said, well, 9/11, or is there anything we can compare this with from a financial perspective of crisis?
So relative to the 70s, if we think about the oil price in real terms, so we take account of how prices have changed, even though the price of oil is still in kind of dollars per barrel, the shock so far is not as big as some of the shocks in the 70s, but obviously it could get there if we saw further disruption. The other big thing is the global economy today is much less dependent on oil. It's less oil intensive in terms of producing goods and services than it was in the 1970s. So there are good reasons to think the fallout from the shock won't be as pronounced, but it all comes back to how long this war lasts for and how long it takes to get back to something that looks like normal once the bombs and the missiles have stopped flying.
I think looks like normal is interesting because we know there's so much activity going on, especially living here in Sweden, that, yeah, the definition of conflict and war, etc., what is it? Of course, there's actions going on, but I think the tricky part here is looking into Åre Business Forum, all the companies here. I mean, how should they navigate, if you would give them some advice?
So one of the things we spend a lot of time doing is we build different scenarios, which people can use to think about how they would respond if shocks crystallize. Because by definition, you don't know exactly when a shock will happen, and you don't know exactly how big that shock will be. But you can think about, what would I do if we saw another slip into recession, or if we saw a big positive impact from AI, for example, on productivity. And that's the kind of work we do where we build those scenarios so businesses and banks can look at what kind of impacts those might have, and we can relate those impacts back to their balance sheets, to what's happening to revenue, what's happening to profitability, and that's core to the part of the work we do.
I'm going to turn to your colleague now, because Marie, I mean, you, the investors, your interactions, what are you hearing at top of mind? Is it exactly what Colin is talking about, or?
Obviously, it's very tied to what Colin is mentioning, which is good.
Yeah.
We would be, well, not in a good position if we were talking about different things than it was top of their mind. But really, it's about, if we look at Iran, for instance, there's the ripple effects of it. For instance, price shocks, you mentioned the oil price. What if that persists for a long time with a very high oil price? What are the ripple effects? Which industries are affected the most, and how does it affect them? That's kind of their thoughts. It's going further. So ripple effects on that and other, I mean, like the supply chain disruption, for
a psychological effect even.
Yeah. The other big topic on their mind is AI and data centers. The AI era creates a high demand on data centers. And there is a commitment with about $1 trillion US dollar on investments in data centers. But yet 2/3 of that is to commence. So they're concerned about the scale. Is the pace good enough? Is it quick enough? Because they also expect to see results on the bottom line from AI initiatives that corporates invest in. If they don't see the bottom line, well, that's kind of concerns. To mention a couple, they're concerned about lots of things, but this is really kind of top of mind right now, I think.
Of course. I would like to end on a positive note. It's a bit hard, but I want a positive answer to this. How will the central banks respond?
You want a positive answer?
That was a bit of a joke. But
I mean,
last question.
It's a tricky one.
Colin,
because
yeah.
when you think particularly about the Middle East, and what we've seen is a classic negative supply shock. It's what economists call it, where typically it's bad for growth or for activity, and it pushes up prices. So it's a little bit stagflationary. You know, it's bad for activity and it raises prices. The classical literature would say when you have a supply shock and you're a central bank, you want to accommodate it if you can. You want to try and look through it. The problem is that's kind of what 2022 was. And we all saw what happened there with inflation. So my best guess is central banks will probably keep policy a little bit tighter than they otherwise would have done, just to make sure that the price effects from this shock are not going to turn into second round effects, and we're not going to see another surge in inflation like we did 4 years ago.
Thank you. I like that, actually. Thank you, Marie and Colin, for coming.
Thank
Thank
you.
you so much.
Thank you.
Thank you so much.